So for 2017, we were positioned for reasonable but strengthening economic growth, which was the main driver we were looking at, and how could we generate a fairly consistent return given that backdrop. And so we were focused on assets tied to the economy, but not dependent upon the profitability of corporate America, which provides some diversification for investors. So if you take it from the top, our structured credit exposure had a very decent year. Not a great year, but a decent year, meaningfully better than high yield, but slightly trailing equities. And this is mainly because as the economy does better, default rates and assets are lower, recovery rates are higher, the starting point price and spreads were attractive, and the cash flows kept rolling in and rolling in. And so for the bulk of this year, we've gotten very good cash flow with small degrees of price appreciation, which has helped drive performance. Our favorite mini theme of playing financials, particularly regional community banks, through the CDOs of trust preferred securities, has had a very strong year. We were fortunate to enter these at fairly cheap prices. And what we have there and still have are improving fundamentals, improving cash flows, and also a massive tailwind from regulatory relief, which was the one thing we thought you could count on coming in this year from Washington. Very hard to bet on any bipartisan legislation or what would the tax reform tax plan look like? Would we ever get infrastructure? But regulatory relief, you can be fairly certain we're going to get. So that's done well. One of our strategies has been a bit disappointing, which we have reduced significantly this year, and that is in the prepay sensitive RMBS space. So, post-election, what we saw was a dramatic increase in interest rates, not only in the front end of the curve in terms of expectations for Fed rate hikes, but also where 10-year Treasury yields went. They went from around 1.75 to around 2.62 in a very short period of time. So because of that, we expected refinance activity to collapse, which is why we maintain a meaningful exposure there. Now, refinance activity collapsed, just not as much as we, market participants, hedge funds, or this Wall Street in general thought, primarily for two reasons. One is home equity extraction is now back. So for most of the post-crisis period, the only reason people refinanced their mortgage was to save $50 or $100 a month on their mortgage payment. What's starting to occur again, given the strong run-up in home prices, is people are refinancing to just suck equity out of their home. It's not a threat to society, the banking system, or the housing market, because we're still only running at 10% of the levels we were pre-crisis, but it's enough to make prepayments marginally faster than one would have expected. So as with any investment thesis, there's the fundamentals and then there's outcomes. And in this case, the fundamentals we think have deteriorated enough to dramatically reduce that. So we've taken it down from about 27% post-election to it'll be around 9% as of January 1st. And I say that because if for some unknown reason the fundamentals were actually very good, but we hadn't made money, that's okay, because at some point you will, right? But in this case, the fundamentals had deteriorated. We concluded that there were better opportunities to go after, so we've done so. Quick recap again, we've had very good cash flow, reasonable price appreciation in structured credit, TRUP CDOs, and a few other opportunities. And the one big disappointment this year would be the prepay sensitive RMBS space.
All investments are subject to risk, including the possible loss of the money you invest. For more information about SkyBridge Capital Multi-Advisor Hedge Fund Portfolio Series G, call 1-888-759-2730 to obtain a prospectus. Investment objectives, risks, charges, expenses, and other important information about a fund are contained in the prospectus. Read and consider it carefully before investing. This webcast is for educational purposes only. We recommend that you consult a professional advisor about your individual situation.